Hello, I'm Tammy and welcome to your week in Forex with MaxiForex. Today we will take a look at last week's market highlights. Volatility continues to be the dominant theme for 2010, as equity, bond, and Forex markets were exposed to continued fiscal tightening in China. Concern also resumed over the instability of Greece's economy and the release of data pointing to poorer than expected earnings from U.S. corporations. Here again with a closer look at the markets, we are joined by foreign exchange analyst Martin Smith. Welcome, Martin.
Hello, Tammy.
Once again, China seems to be making headlines. Can we expect this kind of market reaction every time China releases economic data?
Well, the moves in the market are definitely extreme. Great emphasis is placed on China simply because they are the engine responsible for keeping global economic growth alive. Once we see more consistent positive economic data from the US, Europe and Britain, then market volatility as it pertains to China should lessen.
Well, China just announced early last week that their growth was at 10.7%. That same day, the PBOC, People's Bank of China, also announced new bank lending restrictions. What is the purpose of this?
Well, the restrictions are aimed at reducing liquidity and avoiding asset bubbles. The coupling of these two announcements led to extreme volatility. On the one hand, you have strong growth, which is great for the global economy. And then, of course, the next minute, you've got China intentionally slowing the very growth that will lead to worldwide recovery.
Can you shed some light on the volatility that we've been experiencing in the bond market?
Sure. Obviously, the governments, such as the United States, fund their financing activity through the issuance of bonds. The attraction to investors is that they are risk-free. Now, the downside is they are low-yielding investments. So part of the volatility in the bond market stems from the market's appetite for risk. The greater the risk appetite, the less sought after are government bonds. The other half of the equation relates to central banks, whose interest rate decisions, of course, directly affect bond prices.
So, to an extent, the volatility in the bond market is a result of the equity markets and vice versa.
Well, there's definitely an interplay between the two, as investors shift capital from one market to the other. Additionally, the stock markets are directly subject to risk appetite. As we saw this week, they're also subject to quarterly earnings reports.
With the cross-market thrashing that you mentioned, the USD has been jumping around quite significantly.
Well, this is where volatility really showed itself. There's next to zero shared market sentiment among investors. You can see this by the total lack of correlative trading. Now, correlations which are fundamental to the marketplace are just non-existent right now. This is why you can have a euro 1 week ago break above resistance at 145, only to watch it free fall below support 1 week later and trade below 141.
How is it possible to successfully navigate the Forex market when we're seeing such extreme volatility right now?
You start by defining the trading environment. I would do so by stating that I believe we will be range-bound across the G10 for the next quarter, albeit a very wide range.
When currencies trade the range, what variables are most important?
Support and resistance are crucial. Without them, of course, volatility may fool a trader into believing we're on the cusp of a breakout, only to have the market reverse itself by hundreds of pips in a matter of days. Additionally, you need to adjust your stops to accommodate the more volatile intraday swings, and therefore also monitor your portfolio position risk tolerance.
Thank you, Martin, for coming and sharing with us once again. Until next week, I'm Tammy, and be sure to visit us at maxiforex.ru.